Vikas Khemani joins us. Let's connect with him. Let's talk markets, stocks, and ideas where he's currently excited about and he's investing. Vikas, good morning. Thank you for joining us. It's a different look, Vikas. As the market changes, your look also changes.
It is same, bro.
No, I mean, a year ago, if I take out your old picture versus now, markets were different and your look was different. So you change your look with the markets now, is it?
Time change, boss. You keep evolving with the time. So, you remain same over the years, young, dashing as always.
No, sir. Very kind of you. I guess the view, I think the constant view what both of us have is markets are headed higher and the best of India is yet to come. I think that's the motto which you would endorse and that's the motto of ET now. But long term aside, let's talk about the current scenario. We've had a good comeback, a sizable comeback. Benchmark indices are at a new high. To your mind, what is driving this sugar stroke liquidity rush into India? And do you think this is here to stay?
I think Niku, very good question. And if you remember our conversation some time ago, and we had written a note also on this, as we've said that inflation, interest rates, and dollar has peaked out. It is always coincided with the flow towards emerging market. Whenever Fed raises interest rate for whatever reason, foreigners pull out money from the emerging markets because most emerging markets and current account deficit economies, and any rise in the interest rates in US impacts them through inflation and weakening currency. So that's a typical template most foreigners play over the years, last 30, 40, 50 years. And same thing, as and when that rate peaks out and starts turning back, emerging market receives that flow. So at this, we've been making this case pretty much same that our sense has been last 4 or 5 months that inflation has peaked out. Thereby, it means interest rates have peaked out, and thereby, most of the flow which went back over last 2 years, which is almost $40-45 billion, will come back. And in fact, I would say there would be more flow which will be coming back. For the simple reason, in emerging market basket, India stands out. So I see a situation where both as the interest rates right now, the sense is peaking out, and in my opinion, over the next 1 to 2 years, you will start seeing interest rates coming down. So you will see this whole money flow coming back to India, and this time around, not only overall emerging market basket returning, but India will get larger proportion of the emerging market share. So what we have seen in terms of flow is just a beginning of a very long trend. And this you can go back and check history, tells you this. So I'm quite optimist. I have been quite optimist. I continue to remain very optimist on the liquidity, especially towards the Indian markets.
Is the red flag then? Markets cannot go up like this. Corrections and volatility would be par for course, so to speak. What to your mind would be the red flag? For example, if somebody spoke about valuations in 2020, it had become a red flag. India was a great story, but valuations were haywire. How far are we away from euphoric stroke expensive valuations now?
So, valuation is function of two things. One is, your earnings growth, and second is interest rates, right? So, earnings growth, and interest rates. These are three major factors in the valuation, right? If you look at, earning is reasonably stable. I think we are seeing 15-16% kind of range over at least next 2-3 years. CAGR looks visible, and interest rate scenario is looking down. So, it is very, very kind of natural that India will get re-rated. And if it is backed by your liquidity, will get further re-rated. So my own view, and other thing which I would like to say, that a 2% drop in the interest rates increases the equity valuation by 35%. And this is a very less intuitively understood factor. And hence calling out market looking at only the historical levels will not be great. So I would say India is not expensive. India is not cheap. It's in a kind of a fair value zone. And as liquidity builds, as liquidity comes, because the thing is that Indian liquidity is not going anywhere. So Indian liquidity remains solid, and at the top of it, you are getting the international liquidity. And that, in my opinion, over next 2 years will build a euphoria. There will be a situation where we are going to see a much more euphoric environment than what we are. Intermittent corrections will happen in this phase. There's no denial from that, because that is what markets are made of. But I remain, in a shorter term as well as medium term, quite optimistic on the market.
Talk stocks then, because this is increasingly big, becoming a very stock specific market. Even within sectors, one is seeing not any stock is outperforming. It's not linear in that sense. And I can spot capacity infra, wherein very recently you bought a sizable chunk. Just yesterday we heard of Society Generale as well picking up some shares in this one. What excites you and interests you about capacity?
I would like to stay away from any stock-specific comments.
Sure. But as a theme, why is it that you're bullish on it?
So as a theme, I think if you see the India needs to be built, India is being built. Massive amount of spend is happening on the infrastructure space, constructions as a space, right? And in over last 4, 5, or 10 years, a lot of consolidation has happened in the sector. Many companies have gone out. It's become very consolidated sector. There are very few good quality players who could execute, deliver on time. So like anything else, and this is happening by the way in many sectors. So these, solid players who can deliver, who can build, who can execute are kind of getting better and stronger. And same thing is happening, applying to this space. And I'm assuming, and then you have to do work, of course, on the quality of the management, company's capability, which is the key factor from delivery perspective.
And you've time and again spoke about as to how India is set to become a manufacturing hub over the next decade. How else, as an investor, can you cash in on this?
I think one is, of course, the players who are settled in the middle of this trend. It's like this, when IT trends started in mid 90s, the best way to play was to invest into companies which were benefiting from the IT segment, and there were a lot of Indian IT companies which became big. So I think Indian manufacturing is coming of age. It is only getting better in favor of India from cost competitiveness perspective, from demand environment perspective. And what we have seen, despite whatever returns have been delivered by the market stocks in this space, a very, very long way. So I know one should not get discouraged by saying that stocks have already done well and how much more left from here. So all in the companies in the import substitution space, export oriented space, be it in auto components, specialty chemical, or defense, or garmenting, or footwear manufacturing, capital goods. I mean, it's a very wide area which is going to benefit, and that's the beauty of it. So, and you will see many companies becoming, in fullness of time, 10x, 20x, and that happens. By the way, I'm not saying something new; it has happened in every cycle, and so would happen in this. So, I would say that companies who are with good capability, good management track record, should benefit and will continue to benefit over. And I do see a scenario where there will be kind of a lot more money coming into it. And the interesting part is that manufacturing is never one way. It comes with a cycle, right? Like in 21, chemicals was a completely euphoria. 22, we saw that dying down, and today there's very less interest in that. But in my opinion, you will find many specialty chemical company, APIs company in a very, very sweet spot, and you will see them doing well over the next 2 years because the trend doesn't change. So I think one has to remain very sane and balanced about how to build a portfolio, but the trend is here to stay from a very long-term perspective.
Vikas, also wanted to understand your view on pharma, because that's the dark horse we have been talking about. And if I have it right, you're positive on a couple of names like Loris, Syngene, etc. I know you can't talk stock specific, but nonetheless, the themes you're watching here?
Absolutely. So I think we've been more than pharma. See, pharma is a very generic subject. It's very wide, and there are lots of nuances in that, right? So within pharma, your domestic pharma with the exposed to international formulation, generic formulations, then API companies. So then CDMO, CMO. So I think they're very, very wide, and each of them have a very different business dynamics and return profile. So we've been quite bullish on specialty chemicals, bullish on API as a company, with of course as a segment. CRO, CMO. So all those segments we find very, very sticky and a long-term perspective. Of course, 22 was a year where a lot of corrections happened because 21 was a very big year for margin expansion, inventory accumulation. All those corrections have happened, and now these companies are kind of sitting on a very nice pace. So we continue to remain bullish. We have added some to our position where we felt that corrections was overdone. So that's how, and we remain quite positive on this from a medium-term to long-term perspective.
I'm going to talk about one of your portfolios, that's the Structural Shift Fund. And this is where the real interesting mid-cap names are there. You got Anup Engineering, Tejas Networks, Jet King, Newgen Software. Are these company specific structural shifts you're betting on, or is there an underlying theme which in a sense is the umbrella theme for this portfolio?
So this portfolio is a theme about Nikunj. Again, like I said, that in this 70 to 75% we invest in manufacturing. The same theme which I spoke about, which benefits from the import substitution or export or a combination of both. And the second part is in the technology space, and technology also we prefer where it sits in between manufacturing and IT. So companies like Cyient, we are very strong in ER&D and focused on aviation as a growth driver. Companies like Tejas Network, which are more the telecom equipments, and strong R&D company. So either they're pure tech company or sitting between manufacturing technology, benefiting from this overall theme. And we have a strong conviction. We've been having this conviction for 2 years, over 2 years now, and we continue to believe that it's a decadal trend. And we continue to outline again and again that please do not mistake this with a short-term trend. A massive amount of wealth will get created. And of course, you have to keep identifying companies which will benefit from them. The key conditions being you have to know the business model and more importantly, the management, its capability, intention, the quality. We focus in identifying a lot more on the quality of the companies and business model. That is where so all the companies which you are seeing in our portfolio passes that test.
Any defense names here, big bet on manufacturing. I don't see any railway names here, big bet on capex. Any reason why you avoided PSU railways and defense names in this portfolio?
So I think we have some names. Again, if you can't play direct play, because in my opinion, instead of defense, in defense there's huge euphoria going on right now. Most names are trading beyond our comfort of valuation, and we believe that again they are cyclical. They will. I mean, there's huge euphoria, so you kind of have to be very careful. We have companies like Timken in our portfolio, which benefit from the railway, defense, everything, and industrial capex. So it is indirect play one could play, and again a very good sector, good management. So we try to kind of, for us, business management and valuation is also very important. We are a quality at a reasonable price house. We are not quality at any price. So we focus a lot on. Ultimately, we believe that risk reward is very important. We have to make money. We doesn't have to merely show just the portfolio for the namesake. So, ultimately, we are very conscious. And in defense, we find that right now, euphoria is there, just like how we saw in chemicals in 21.
Before we let you go, a quick word on the IT space as well. You've been quite positive on that. You have names like Cyient, etc. in your portfolio. But this morning as well, there was a JP Morgan downgrade coming in Persistent Systems, which is down about 3%. The entire IT space actually is on the back foot. Is it a time to buy IT, or just hold your horses and there'll be better opportunities to buy?
No, I think we've been very positive on IT for some time. Nikunj know this, and I hear is an interesting take on IT I can share. Our whole view also is that IT is also a good play on interest rate down in the US market. See, today in IT, whatever is happening, whatever order book accretion we have seen in last 12 months, 18 months, mind you that has happened in the middle of a pessimism or recessionary kind of mindset across the board. So if any company is giving order, they are giving more survivor order, must order to be given, because in that kind of environment, no CEO would spend money which is for futuristic kind of plans, right? When the environment is so bad, the growth orders are yet to come. Growth spend is yet to come. And as the environment in the US settles down, which could be 6 months down the line, 12 months down the line, I don't know, but I have a firm conviction that we will start seeing, once the number prints out, I mean, interest rates coming down. And as that happens, IT companies will even see an acceleration on the growth. So, and reasonable valuation, good dividend yield stories. So in your portfolio, you've always got to have a bit of a balance. And our conviction is, and in IT also, every cycle you will find some companies becoming big. Like in 2009 to 15 cycle, companies like HCL Tech, Mindtree, LTI, they became very big, right? I mean, they became 8x, 10x, right? So we think that in this cycle also, some companies will become very big, over a 5-6 year period. So history repeats itself. So our idea, our endeavor is to look and invest into those kind of companies which can become multi-baggers in this cycle of IT.
Okay, Vikas, we'll let you go on that note. Good to have you on the show as always.
Thank you, Aisha. Thank you, Nikunj.
Okay, let's